What do you need to know about cryptocurrency regulation as an investor? The answer lies at the intersection of finance, technology, and law. It's here that we begin to unravel the complexities of the cryptocurrency landscape. Cryptocurrency is no longer the niche interest it once was. It has grown into a global phenomenon, catching the attention of investors all over the world. But with great opportunity often comes great risk. The volatile nature of cryptocurrencies is what makes them a high-risk, high-reward investment. Prices can skyrocket one day and plunge the next. It's a digital roller coaster, and understanding the regulatory landscape is your safety harness. Regulation, in its essence, provides structure and security. It serves as a protective layer for investors, shielding them from potential fraudulent activities and ensuring that their investments are safe. But with cryptocurrency, a disruption in the traditional financial ecosystem, the rules of the game are still being written. This uncertainty can be both a boon and a bane for investors. It could mean untapped opportunities, but it also means uncharted risks. The world of cryptocurrency is constantly evolving. New coins are minted, old ones fade away, and the rules change as governments and financial institutions try to keep pace. As an investor, it's not enough to simply keep an eye on price trends and market news. You must also stay informed about changes in regulations, as these can significantly impact your investments. Regulation also plays a key role in legitimizing cryptocurrencies. It's the difference between a Wild West scenario and a mature market. When a cryptocurrency becomes regulated, it gains credibility. This can attract more investors, potentially driving up the coin's value. Understanding cryptocurrency regulation is not just about avoiding legal pitfalls. It's about making informed decisions, maximizing your returns, and minimizing your risks. It's about navigating the complex world of digital currencies with confidence. Now that we know why it's important, let's dive into the history of cryptocurrency regulation. How did the journey of cryptocurrency regulation begin? Let's take a step back to the early days of cryptocurrencies, when the landscape was akin to the Wild West, unregulated and dominated by the pioneering spirit of its participants. The first cryptocurrency, Bitcoin, emerged from the shadows in 2009. It operated in what we could describe as a regulatory vacuum. There were no rules, no oversight, and no governing bodies keeping an eye on things. It was a brave new world, filled with the promise of decentralized finance and the allure of unregulated transactions. As Bitcoin gained traction, it found itself an active participant in the darker corners of the internet, the infamous dark web. Here, Bitcoin became the currency of choice for transactions that shied away from the prying eyes of law enforcement and regulatory bodies. This anonymity, while appealing to some, also cast a shadow on the cryptocurrency's reputation. It wasn't all dark, though. Bitcoin's decentralized nature also appealed to those seeking an alternative to traditional banking systems, those who were disenfranchised or simply desiring financial independence from the status quo. This broad appeal, along with the increasing popularity of Bitcoin, led to a surge in its value and subsequently caught the attention of mainstream finance and governments around the world. As Bitcoin's profile rose, so did the realization that some form of regulation was necessary. The early days of cryptocurrencies were marked by a high degree of volatility and risk, and without any regulatory oversight, investors and users were at the mercy of market manipulations and scams. The need for some form of regulation became increasingly apparent, and so the wheels of bureaucracy began to turn. Governments worldwide started to take notice of this digital currency phenomenon and the potential risks it posed to their economies and their citizens. The question was no longer about whether cryptocurrencies should be regulated, but how. So the Wild West days of cryptocurrencies were coming to an end, and governments started to take notice. This marked the beginning of the journey towards cryptocurrency regulation, a journey that would shape the future of digital currencies and their role in our financial systems. What happened when governments started to take notice of cryptocurrencies? Well, the advent of regulation wasn't exactly a walk in the park. As cryptocurrencies began to grow in popularity and value, they inevitably caught the attention of governments worldwide. This led to the first steps towards regulation, with countries like the United States and China taking measures to control cryptocurrency activities. In the United States, the Securities and Exchange Commission, more commonly known as the SEC, started to take an interest. They began by classifying certain cryptocurrencies as securities, which brought them under the purview of existing financial laws. This meant that initial coin offerings, or ICOs, had to comply with the same regulations as traditional securities offerings, a significant change for the world of cryptocurrencies. Across the Pacific, China took a more heavy-handed approach. The Chinese government outright banned ICOs and shut down domestic cryptocurrency exchanges. This move sent shockwaves through the crypto community, causing the value of many cryptocurrencies to plummet. These first steps towards regulation had a profound impact on the value and stability of cryptocurrencies. For some, the introduction of regulations brought a sense of legitimacy, boosting their value. For others, particularly those that fell foul of the new rules, their value dropped significantly. But it wasn't just about value. The introduction of regulations also brought about a new sense of stability. With clear rules in place, investors could have more confidence in the system, reducing the volatility that had previously been a hallmark of the crypto market. However, this newfound stability came at a cost. Many in the crypto community felt that the regulations were stifling innovation and limiting the potential of cryptocurrencies. There were concerns that these new rules were being imposed by governments that didn't fully understand the technology and its potential. With these regulations, the world of cryptocurrencies changed drastically, but the story doesn't end here. The advent of regulation was just the beginning. As we'll see in the next scene, the world of cryptocurrency regulation continues to evolve, with new challenges and opportunities emerging all the time. Where do we stand today with cryptocurrency regulation? That's the million-dollar question, isn't it? The current regulatory landscape is as varied and dynamic as the cryptocurrencies themselves. Let's delve into it. Let's begin with the United States, a significant player in the global crypto market. The Securities and Exchange Commission, or SEC, has been taking an active role in cryptocurrency regulation, classifying some digital assets as securities. This means they fall under the same regulations as traditional financial assets, which has both pros and cons. On the positive side, it offers investor protection. However, it also means more red tape for crypto companies. Across the pond, in Europe, the approach is slightly different. The European Union is working towards a regulatory framework called the Markets in Crypto Assets, or MiCA, aimed at unifying crypto regulations across member states. The aim is to foster innovation while ensuring investor protection and financial stability. Moving to Asia, the regulatory landscape is a mixed bag. Some countries like Japan and South Korea have embraced cryptocurrencies, with comprehensive regulations in place. On the other hand, China has taken a harder stance, banning cryptocurrency trading and mining. These diverse approaches have a significant impact on the global cryptocurrency market. While stringent regulations can stifle innovation, they can also bring legitimacy to the sector and protect investors. On the other hand, a lack of regulation can create a Wild West environment, with the potential for scams and market manipulation. The ongoing debate is about finding the right balance between fostering innovation and ensuring investor protection. Some argue for a self-regulatory approach, where the crypto industry sets its own rules. Others advocate for more government intervention. There's also a growing conversation around potential future changes in regulations, such as the introduction of central bank digital currencies, or CBDCs, which could drastically reshape the crypto landscape. The regulatory landscape is ever-changing. So where does this leave investors? Well, it leaves them in a dynamic and evolving space. The key is to stay informed, understand the risks, and navigate the crypto world with caution and diligence. What are the key takeaways for investors in this evolving regulatory landscape? Let's break it down into a few key points. First, remember that cryptocurrency regulations are not static. They're constantly changing and evolving, just like the digital currencies themselves. It's crucial to stay abreast of these updates. Regulatory changes can influence market trends, and being in the know can provide a competitive edge. Second, it's all about risk management. Understanding the regulations is part of this. Regulatory compliance can help mitigate legal risks, while non-compliance can lead to severe penalties. So do your due diligence. Research the regulations in your country and understand the legal implications of your investments. Third, be aware that different countries have different rules. Cryptocurrencies are global, but regulations are not. If you're investing from outside your home country, familiarize yourself with the local laws. Even within the same country, regulations may vary by state or region. This can affect everything from the legality of certain transactions to your tax obligations. Fourth, don't forget about taxes. Yes, cryptocurrencies are subject to tax laws. In many countries, they're treated as property for tax purposes, so any gains from your investments could be taxable. It's important to keep accurate records of your transactions and consult with a tax professional to ensure you're in compliance. Fifth and finally, remember that knowledge is power. The more you understand about the regulatory landscape, the better equipped you'll be to navigate it. There are many resources available online to help you stay informed. Regularly check government websites, follow reputable news sources, and consider joining online communities of other investors. Understanding the regulatory landscape is crucial for any investor in the cryptocurrency market. Stay informed, stay safe, and happy investing.